Hello everyone, I welcome you today for the second session of our sectorial series. Today we have our learned speaker Asif Mansoory, who is associate partner with ELP and have hands-on experience on handling various e-commerce issues relating to GST. So I'm sure today will be a great session and Asif bhai will take us through the different issues which industry is facing currently with GST authority or GST litigation. So with this brief, let us move ahead with the session. So I request everyone to please kindly place your hand on heart for the ICI motto. Shiraji.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रद ब्रह्मा तदेव मुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
So now I request CA Praveen Khemka to kindly introduce this.
Hello everyone, good evening. मेरी आवाज आ रही है? Yeah. Mr. Mohammed Asif, Mohammed Asif Mansoory is an associate partner in the tax practice of ELP and focus on indirect taxes. Mr. Asif had over 10 years of professional experience in advising Indian and multinational clients on indirect matters and allied laws. Asif has assisted clients and associates across sectors in their transition into GST, including advising them on complication arising post implementation of GST and custom matters. His area of expert prior to the introduction of GST covered excise, service tax, central tax, as well as VAT also. Mr. Asif also advised clients on matters related to foreign trade policy, state and central incentive policy, advocacy, business restructuring option, ongoing business operation, many things. He has also worked on key projects involving process review of examining sufficiency of a system from a tax perspective. Mr. Asif has worked with clients across sectors including banking and finance service, FMCG, logistics, auto, leasing, media entertainment, IT, power and renewable energy, etc. Prior to ELP, Mr. Asif was part of the tax team at PwC and EY. Thank you.
So Asif, we welcome you today. So now it's over to you, sir.
Sure. Thank you, Gautam and Praveen for the introduction. I'll begin with sharing my screen. Let me know if the screen is visible, then we
yes,
start.
It's visible.
Yeah, sure.
Yes, sir, visible.
Sure. So hi, good evening, everyone. As Gautam has explained, laid down the intent of the session is to go through the key provisions for e-commerce sector. The presentation is divided into different parts. First, we go through the legal provision, which are directly talking about the e-commerce sectors. We will also take a few case studies to understand the provisions a little better. Then we go on to understand how the typical e-commerce transactions are structured for a service provider, seller or supplier of goods. After that, we move on to the few issues that we've seen while advising clients on the e-commerce sector. We have answers to few, we may not have answers to some of the queries, but yeah, I would still enlighten you on the issues that are going on in the industry. And lastly, we've also help associations to represent before the CBIC on how to resolve the indirect tax challenges for the sector. So I'll take few points over there, and then the other regulations that should also be taken into consideration for any e-commerce operator. Sure. So I said before, the basic thing is to understand what is e-commerce, electronic commerce, and what would be electronic commerce operator, and then any GST implications will have to be analyzed. So the definitions are there. It's a very simple definition which says e-commerce means supply of goods or services through including digital platform or electronic network. And e-commerce operator is a person who owns such platform and manages. Now, if you see the definition of electronic operator covers within its ambit all kinds of goods or services or both, which are provided using a digital or electronic network. Digital network and electronic network, both of these terms have not been defined under the law. So they have to be understood of how they are being understood by people in the general trade parlance. So a website or any kind of a web or internet-based platform can be considered to be an electronic network. Further, the definition of electronic commerce operator is wide enough to cover any person who owns, operates, or manages such digital or electronic network. E-commerce operator as well as the suppliers on the e-commerce platform are mandatorily required to obtain GST registration, even if their turnover is below the basic threshold limit. So there's a threshold limit of 20 lakhs, which is applicable, and 10 lakhs for special category states. However, after introduction of GST, there was representation for services sector, and government came out with a notification specifically exempting supplier or services through e-commerce sector from obtaining GST registration until and unless their turnover exceeded the threshold limit. While representations for giving similar exemptions to supplier of goods is also there, and hopefully the government will come out with such exemption shortly. Apart from this, the composition suppliers are also not allowed to go for composition scheme. So if you want to start supplying on an e-commerce platform, you need to be in the regular scheme. Now we just take a small case study. So here the company is engaged in the business of assisting believers, followers, and devotees to book pundits for their online religious ceremonies like pujas, etc. The services is being provided through their own website. So the company is operating a website. They allow devotees to hire pundits for performing puja. Now, at the same time, the company also hires various experts, pundit, and keeps a repository of all of them in order to provide the religious ceremony services. Now, services are directly provided to the customers on the P2P basis, and the consideration for such services are directly paid to the pundit, or the customers can also make payment to the company. Now, here the issue that came up for consideration was whether, so there's an exemption in terms of serial number 13 of the exemption notification, which is services provided by way of conduct of any religious ceremony, and such ceremony, then it is exempted from payment of GST. The company in this case is of the view that they are eligible for this exemption since they are providing services by way of conducting religious ceremony by hiring pundits for the welfare of the people by managing their websites. So from a plain reading of the exemption entry, it appears that it covers services by a person by way of conduct of any religious ceremony. Thus, it looks like that it covers services provided by a person who's conducting the religious ceremony and not the person who is operating the website. So there are two transactions. The website company is allowing the customers to book pundits through the website, and the pundits are actually performing the religious ceremony. So the entry appears to be that it is going to allow exemption to the pundits who actually provide services to the people. In this case, the company is only facilitating or making available the pundits for conducting the puja. The company, as we can see, is not actually involved in performance of these services. It is just an intermediary. Now, having said that, whether the company is not eligible for this exemption, we will have to see whether the company qualifies as an e-commerce operator or not. In this regard, the following points have been taken into consideration. Like, company is providing services and doing the activities through electronic network, which is owned by them. The business is completely done through the electronic network, and operation and management of digital platform for provision of services. So by seeing all of these activities that the company is performing, it seems that the company is a e-commerce service provider. So this matter then came up for the advanced ruling authority, where they've upheld that the company will not be eligible for the exemption because they are not performing the religious ceremony. However, they qualify as a e-commerce operator, and therefore they will have to take registration irrespective of the basic threshold limit. Then after registration, we move on to the next interesting topic, which is aggregator tax. So what, by virtue of section 9, the government has the power to specify the categories of services, the supply of which, the tax on supply of which shall be paid by the electronic commerce operator, and only if the services are supplied through it. And all the provisions of the act will apply to the e-commerce operator as if they are the person who are supplier, and therefore they will have to undertake all the compliances. Here, the important point to be seen is that the services need to be supplied through the e-commerce operator. Then only these notified services, they will be liable for payment of tax. Now, in this regard, notification 17 has been issued, which provides a list of services. I've just listed down all those categories. The first is transportation of passengers by radio, taxi, motor cab, motorcycle. We know company like Uber, Ola, Rapido, they are providing these services. And if you see, there is another remark above the table which says RD plus URD. Now, in case of service providers, the government has granted basic threshold exemption limit to the service providers, that until and unless they cross the limit, they are not required to take any registration. However, by virtue of this notification, if a transportation service provider is there, then whether they are registered or they are unregistered, the e-commerce operator will have to pay GST. Now, coming to the second category and third category of services, accommodation in hotel, guest, campsites, or any other place for commercial or residential lodging. Now, these services, the intermediary here are Make My Trip, Yatra, Clear Trip. Similarly, there are a lot of house cleaning, plumbing, or any household services that we need. All those services are provided by companies like Urban Company, Urban Pro. Here, the provision says that only when the service provider is not registered under GST, in those cases, the aggregator will be liable for payment of tax. However, if the respective hotels or the service providers are already registered, then the aggregator tax will not come into picture. And recently, towards the end of last year, the government added one more category into this list where restaurant services. So restaurant services that are provided through Swiggy, Zomato, in all those cases, they made Swiggy and Zomato liable for payment of GST instead of the relevant service provider. So these are the 4 categories of services notified for aggregator where the e-commerce operator has been made liable for payment of tax. So this is a sample invoice of how the e-commerce operator invoice would look like. And this is an example of an unregistered hotelier where the hotel is selling the room at the standard price of 13,400. Make My Trip is earning a commission, and then there's a GST on their commission, which comes to 3,000. And then there is a highlighted portion towards the end of the invoice, which says that GST on hotel accommodation charges by the e-com operator is 2,412. So here, and then towards the right in yellow, you see Make My Trip will pay 10,238 to the hotel. So what they will do is they will, to the customer, they will show 13,400 plus 2,412, which is the tax portion. The tax that they collect, they will directly pay to the government. And while making payment to the hotel, they will deduct their commission. So that's how the transaction will flow. Now here we move on to another case study, which is also an advanced ruling. The issue here, I'll take you through the issue. So the company is engaged in the business of taxi aggregation services, wherein it provides IT platform, including mobile and website, to both the customers as well as the taxi drivers to integrate them on a single platform. For providing this IT facility, they collect a monthly usage fee from the taxi drivers. However, no money is collected from the customers. Upon completion of the services, so once the driver is taking the passengers and the journey ends, invoice is issued to the customer through the app on behalf of the driver. The payment for such services is directly collected by the driver, and it may be through cash or e-payment, but in no case the company which is providing the platform is receiving the consideration. The query in this case is to whether money paid by the customer directly to the driver of the cab for the services is liable to GST. That's the first part. And second, whether the company is liable to pay GST on the said amount. So what needs to be determined is, in this case, will the IT platform company, will they be considered as an e-commerce operator and they have to pay tax as an aggregator? And the entire debate is related to interpretation of the phrase, such services are supplied through it for attracting the aggregator tax. Now, the arguments that were put forth for non-applicability of GST. One is that the distinction between services being supplied through it as against services being booked through the platform, that must be understood for doing the analysis. So the difference that they're trying to bring out is services being supplied and services being merely booked. Now, in case of the words supplied, there has to be a continuous link of provision of service from start till end. And there should be complete responsibility of the deemed supplier, which is the IT platform. The services supplied through the company, basically the company does not have any privity of contract with the customer, as the customer is directly selecting the cab and they are making the payment. Further, like popular models of Ola, Uber, they are not recovering any trip-based commission, and they don't even pay any bonus to the drivers basis the number of trips that they've done. They are just providing an IT platform for a fixed usage fee. Now, observation. So for foremost, we need to evaluate whether the company qualifies as an e-commerce operator or not. Once it qualifies as an e-commerce operator, then we have to decide whether aggregator is applicable or not. So the company has developed a digital platform which aggregates the taxi drivers on a common platform. The service of transportation is supplied by the driver using such digital application. The company is owner and it operates the IT platform for supply of transportation services, and everything is managed digitally. Using this digital network facility, the company provides aggregations, taxi aggregation services, wherein they connect both the driver and the operator. They act as an intermediary. Now, while deciding on this, that section 9.5 will be applied, because the company is managing everything through a digital network. And as we've seen, the definition is very wide. The company will definitely fall under the definition of an e-commerce operator. Now, applicability of 9.5. For this, the point that we have to look at, that for booking a ride, you have to be on the digital platform, and which is the first steps towards the supply of service. So if you are not going to the digital platform, you will not be able to avail the services at all. The nature of e-commerce activity is such that the supply of goods or services are both happening through the electronic mode. And here, booking for taxi ride on a digital application is a part of the activity of supply. So the services consist of right from booking till the time the driver picks up the customer and drops. So one part, which is the booking, starts from the digital platform. Therefore, booking for a service is also an integral part of the supply chain. And accordingly, it was then held that providing of platform will also mean that the services are supplied. So the interpretation has to be, even a part of the service is through a digital platform and not the end delivery. Then also you will be getting covered under the provisions of section 9.5. And accordingly, the company will have to pay tax as an aggregator of transportation services. The next obligation on the e-commerce operator is collection of TCS. So by virtue of section 52, the government has casted the liability on the e-commerce operator to collect an amount not exceeding 1%. So 1% is to be collected on the net taxable value of the supplies made through it. And the important condition is the consideration for such supplies also to be collected by the operator. So the supply should be made through the e-commerce operator. They should not be and the consideration should be collected. Now, the reasons for introduction of TCS. So this is primarily to prevent tax evasion. TCS enables the government to have a trail of transactions at a single point where the transaction is actually taking place. And e-commerce, they are being an organized sector, are easily traceable rather than going after multiple people. So the government found it easier to saddle them with the additional burden of collecting and then filing the returns for TCS. And since TCS is collected, the supplier will also be forced to file their returns, make proper disclosure, and then only they'll be allowed to take the credit of the TCS which has been deducted by the supplier. Now, on perusal of the provision, it emerges that following conditions have to be cumulatively satisfied for attracting the TCS provision. First, that we need to keep in mind is that the transaction should be a taxable supply. The e-commerce operator should not be acting in the capacity of an agent of the supplier. So it has to be a principal to principal transaction between e-commerce operator and the supplier. The supplies should be some other supplier should be making a supply using the platform of the e-commerce operator. And lastly, the consideration for services supplied by other suppliers should be collected by the operator. That is, such operator shall have the right to collect the amount towards the supplies made through the platform. these conditions are mutually exclusive and they are required to be satisfied cumulatively. So if any of these conditions are not satisfied, the provisions of TCS will not apply to an e-commerce operator. Now, once it is determined that you have to undertake TCS compliance, the e-commerce operator is required to obtain a TCS, a specific TCS GST registration in all the states from where the supplies are being made by the supplier. So assuming the e-commerce operator already had a registration which is for the regular supplies they are making, they also need to have another registration specifically for the TCS compliance. One relaxation that has been provided by the government is that in cases in states or union territories where the e-commerce operator does not have a physical presence, they are allowed to declare the head office, which would be in the state where they have the registered premises, as the place of business for obtaining the registration. So this relaxation is specifically for e-commerce operator going for a TCS registration. Now this is an example of how an invoice looks like when a TCS is being done. So we can see Go Ibibo, the room charges are 2,500 and there are extra charges of 12,000. So that totals to 37,500. Then there are other items, Go hotel taxes, Go Ibibo commission. TCS is deducted on 37,500, which is 1%. And after that, reducing the commission and TCS, the net amount is paid by Go Ibibo to their respective hotelier. In this case, the hotelier is a registered person. Therefore, the computation is like this. Otherwise, we would have talked about 9.5. Now, this is another case study where it is to be determined whether 52 TCS under 52 will be applicable or tax has to be paid as an aggregator. Now, in this case, the company DriveU, basically the company is aiming at bringing drivers. Drivers are the service providers and the customers owning private cars on a common platform by which the customers can place a request for services of a professional driver. So it's like any person who has a car but is not able to drive, or for whatever reason they need a driver, they get into that platform. There are various drivers available. You can select a driver. So the drivers who are offering their services on these platforms are individual and independent service provider. Now, in return for use of company's electronic platform, the drivers are charged a convenience fee. The company as such by themselves are not engaged in providing transportation services or the driving services. The customer offers the mode of transportation. Provision of service by driver to the customer is subject to the agreement entered between the customer and the driver, and the company is not a party to such agreement. Now, towards the end of the commute, the customers are charged for the driver services, which can be paid directly to the driver or to the company. So if the driver receives, they pay with the convenience fee to the company, or company deducts the convenience fee and pays back to them. Now here, the company, because they are owning a digital platform, everything is taking place digitally, they duly qualify as an e-commerce operator. Now, further, for provision of section 9.5, the aggregator tax, they are applicable on services by way of transport of passengers by radio taxi, motor cab, maxi cab, motorcycle, etc. So the services have to be services of transportation of passenger by radio taxi. Now, in this case, services provided by the driver is not falling into this category due to the following items. Like the drivers are neither the employees of the company nor they are hired by the company. The drivers are listed on the portal and they provide services to the customer on a P2B basis. The drivers are not supplying the services in their own vehicle, but they are driving the vehicles belonging to the recipient of services who have hired them. And hence, it can be said that they are not providing services of transportation. Now, so 9.5 is also ruled out. We come back to the TCS provision. Here, TCS is applicable. However, to the extent of consideration collected by the company for the services provided by the drivers to the consumers, the same shall be liable for TCS. So whatever money is collected by the driver directly from the customer, no TCS should apply. However, the money that is received by the company, the provision of TCS will come into picture. Now, this is a broad chart of the interplay between the aggregator tax and the TCS. Now, one thing that we should keep in mind is aggregator tax and TCS, both of them will not apply at the same time. So it is either or, it is never both of them will apply at the same time. So e-commerce operator, the services are 9.5 services, which are specifically the aggregator services. Non-9.5 supplies, all other supplies which are made by the e-commerce operator. So it's a very simple. If the supplier is a registered person who is supplying any services other than the specified 4 items, then aggregator tax is not to be paid. It only TCS has to be collected. Because since the supplier is registered, they will pay the tax by themselves. And in case of an unregistered supplier, so there are categories of service providers not falling under 9.5 and still providing services through the e-commerce platform. In their cases, neither aggregator tax applies nor the TCS applies. Now coming to 9.5, 9.5 is then again divided into unregistered and registered. So for unregistered suppliers, aggregator tax is going to be collected. However, when we talk about registered suppliers, there are 2 cases. One is a case where, like services where whether the supplier is registered or not, the company, the aggregator, the e-commerce operator will have to pay the tax. So that is like, for example, transportation services. However, in cases where services where like a hotel where supplier is not registered, then only the aggregator tax will apply. Now, these are the key compliances that an e-commerce operator has to do. So e-commerce operator, obviously, because they are doing TCS under section 52, they have to file a return in form GSTR 8 for the TCS they are collecting. And the limit is 10 days from the end of the month. After filing of TCS return, they go on and file their GSTR 1. So GSTR 1 is for the services that they are providing on their own account. So it is nothing to do with the services that are being provided from their own platform. Once after GSTR 1, regular GSTR 3B for the liability of outward supplies, reverse charge payable by them on their own account. So any errors done in GSTR 8, GSTR 1, they can be rectified by 30th November of the next financial year or filing of the annual statement. Lastly, e-commerce operators, they have to file a different form, which is GSTR 9B. This is an annual statement and the due date is same as your 9C, which is 31st of December. Now coming to e-tailers, the suppliers on the e-commerce platform. So whatever supplies they are making through the platform, they have to file GSTR 1, B2B, B2C, all categories have to be properly filled in. GSTR 3B for the liability that they have to pay on their own supplies, and after taking credit of the TCS collection done by the e-commerce operator, the TCS goes and sits in the cash ledger. So it becomes a part of the cash ledger, which can be utilized for payment of your liability. Then same rectification can be done by 30th of November or filing of annual statement. Then a regular supplier on the e-commerce operator needs to file GSTR 9, which is the annual return, followed by and along with GSTR 9C, which is the reconciliation statement. And both of these statements have to be filed by 31st of December. Now, while reporting for all other transaction is done in the standard way in the different tables, table 4, 7, and so on and so forth. With respect to 9.5 cases, so 9.5 cases where the e-commerce operator is making the payment of tax as an aggregator, in that case, there's a specific circular which provides how the reporting needs to be done by the e-com and the person who's supplying such services. So the e-commerce operator, they will report in table 7A or 4A, depending whether it's a registered person or not. And in GSTR 3B, they will report it as a normal outward supply. So there's no specific column in GSTR 3B where they can provide that these are the liability which is being paid as a aggregator. When you come to the supplier or through the e-commerce portal, they have to report both the transaction in GSTR 1 and 3B nil and exempted supply. Because the tax is already paid by the e-commerce operator, there is nothing, no tax to be separately reported by them in their respective GSTR 1 and GSTR 3B. Now we move on to the next section where we see how a typical e-commerce transaction works. So this is just a informative slide where how big, large e-commerce companies are divided. The group is divided into different companies carrying on different functions for the same e-commerce business. Like we see there, so the company will first have an e-commerce platform, the platform which owns and manages the marketplace like Amazon, Flipkart, Paytm Mall. Then these entities also have an entity which acts as a supplier on these platforms. As we know, Cloudtail is one of the biggest sellers on Amazon. Flipkart has its own company doing this. Now, another leg of the transaction, when a customer is booking these, the goods also have to be supplied. And that's how the logistics comes into picture. And they are also there in the logistics sector as well, having their own company. Because the transaction is happening through a digital network, everything is online. The payment is online in most of the cases. So there is an opportunity to start their own payment company, payment app. So the payments can happen digitally and everything is in their control. And interestingly, Flipkart, they have also started with GVs, which is their own company that provides after sale services. So once, say you buy any mobile on Flipkart, there is any problem, any after sale services required, this is the company that comes to your rescue. So it's a standard structure. This is based on how the large e-commerce operators work. Now, this is a standard e-commerce model, commission-based model, goods for sale of goods. So it's like there is a marketplace where supplier will list their goods. They will provide the details about their product, the selling price, the inventory details, and everything is there on the portal. So the customer who logs into the portal, they can see, select, and accordingly an order is placed on the e-commerce portal. Once the customer places an order, the order is sent for intimation of the supplier who's listed such product. The supplier, after getting an order, needs to pack the order, ensure that the product is delivered to the customer. The delivery can be in different mechanism. The delivery can be directly done by the supplier himself, or they can appoint a courier agency directly, which collects the parcel and gives it to the customer. Or as we saw, the e-commerce portal also have their own logistics company where the supplier have the option to opt for such services. So the logistics company will come, pick up the product and deliver it to the customer. After delivery, the customer, so the consideration, while it's coming fourth in the list, the consideration can be paid at the time of placing the order, or the consideration could be cash on delivery. Once the e-commerce operator collects the money, they make the payment to the supplier towards the supply of goods that they have done. However, they will deduct their commission, which is the marketplace listing fee, the commission of sale of goods. And if the logistics is through them, they will also deduct the logistics fee. Now, for an e-commerce operator, the key revenue streams would be the commission that they receive. So commission is received on each sale that takes place through their platform. Shipping charges where the supplier opts for it. And interestingly, we've seen those ads where one-day delivery options are provided. So in those cases, the e-commerce operator is owning a warehouse the supplier can deposit their goods in such warehouses. From that warehouse, the e-commerce company directly delivers to the customer. So because the goods are in their control, the delivery happens faster. So warehousing charges is another stream of income that they earn. Now, similarly, commission-based model for services. So a customer makes a booking on an e-commerce portal for hotel like Clear Trip, Go Ibibo, Make My Trip. The portal will connect you to the respective hotels. Now, once the booking is done, the e-commerce operator collects two fees, which you will see. One is when the customer is making any payment or any booking, they are charged a convenience fee. So convenience fee is basically a fee that is charged to the customer for giving them the opportunity to sit at their home and book the services. Whereas hotels pay a commission and a listing fee similar to how it works in case of goods. So on the left hand side, you can see invoice by ClearTub, which is going to the customer, which only talks about the room rate, GST, and the convenience fee. Whereas the invoice that goes to the hotel, they show their commission and the commission is deducted when the payment is actually made to the hotels. Now this commission brand fee that the e-commerce operator recovers. So in a regular transaction, if you see the hotel tariff is say 8,000 rupee, GST, because the rate of hotel per day is about 7,500, 18% GST is charged. The e-commerce operator, out of their own, to promote their business, to gather more customers, they give a discount out of their own will. So there's a discount of 1,000 plus the convenience fee will still be recovered by them. Convenience fee is added and the total amount which is paid to the customer is paid by the customer is 9,240. Whereas e-commerce operator is making a loss of 200 rupees in the transaction because they are giving a discount of 1,000 and recovering a fee of 800. So they pay the entire money to the hotel. Now, in some cases, they tie up with the hotel in a way where they will not take a commission, but the e-commerce operator and the hotelier, they share the convenience fee. Now, which is the other scenario that is there on the table. So here what happens is the hotel tariff is listed as 8,000 and upfront discount is given and borne by the hotel by themselves. So the net tariff comes to 7,000. And because it is less than 7,500, the rate of GST is 12%. So here the customer gets a lower GST rate benefit, hotel charges are there, and the convenience fee that is received, 800 rupees is collected from the customer. However, the customer ends up paying a lesser amount. That's the difference between 12% and 18% GST that they had to pay and 1,000 rupee discount. The amount that is to be paid by e-commerce operator would be the total tariff charges of the hotel plus the percentage of the convenience fee that they have to share. Now here in the commission-based model, the problem could be that the tax authorities will argue, like as we saw, there was a tax arbitrage of 6%. The authorities can argue that the bill has been artificially split so that the tariff comes down below the 7,500 mark. So in this case, it is advisable that the agreement should be very clear and it should substantiate that the e-commerce operator is collecting money on behalf of the hotelier. They have no say in deciding the tariff or the price that is given by the hotelier. And if possible, some other arrangement could be explored without doing a sharing of the brand fee or the convenience fee. Now, from a hygiene perspective, convenience fee and brand fee, one and the same thing. They should separately appear on the voucher at the time, which is issued at the time of booking. The e-commerce operator should issue a separate tax invoice to the customers for such fees. And it's a general hygiene thing that a same terminology should be used across the different documents. Now, the tax authorities could say that convenience fee is going as a part of the hotel charges, and therefore it becomes a composite supply, one and the same. And accordingly, GST should be levied at 18% on the entire value. So here, for composite supply, it is important that the transaction should be, or the supply to two or more supply should be done by the same person. Here, however, factually, the hotelier is providing accommodation services and the e-commerce operator is providing the booking services. Now, moving on from the commission model, there is also a buy and sell model where the entities themselves buy the products. They purchase the inventories from different vendors, and those inventories are listed and sold to the customers directly. So in this case, because if it is the same entity, then TCS, nothing will apply because it's selling of own product to the own website. Now, in case of services, buy and sell model also works where the hotelier will actually, the e-commerce operator commits a fixed revenue to the hotel or a minimum amount that they will earn if they lease out the entire inventory. So a lot of time we see if you buy a room on the hotel website, it is expensive. Whereas if you go to Make My Trip, you will end up getting 30%, 40% cheaper than the price which is there on the website. So that's when the buy and sell model works. They buy the entire inventory. They commit a minimum revenue. However, the transaction will still work where there'll be a share of revenue between the e-commerce operator and the hotel. However, if the hotel is not earning the minimum threshold, the committed amount, then the e-commerce operator needs to pay that money. Now, when the customer is booking, the experience or the interface continues to be same for the customer. They pay for the tariff and the convenience fee. Now here, the problem again is where the company, the operator is charging hotel tariff plus convenience fee from the company. What we can see is there are two or more supplies that are being provided by the e-commerce operator. So the e-commerce operator is offering the hotel tariff, hotel stay, plus they are recovering a convenience fee. Now, as we saw in the previous example, the argument that we took for non-applicability of composite supply was there are two different persons supplying two different services. However, here there is one single company which is providing both the services. And if you see the definition of a composite supply, the supplies have to be naturally bundled and provided in the usual and ordinary course of business. So therefore, there is a high risk that this transaction will qualify as a composite supply, and therefore, in case of composite supply, the tax has to be paid based on the principal supply. So the principal supply will obviously be the hotel tariff and not the convenience fee. So therefore, both of them will be combined and tax will be paid as if the entire supply is supply of hotel accommodation. Now in the table, if suppose we split both the services supplies, then if the hotel tariff is less than 1,000 rupee, GST rate is 0. So therefore, if the rate tariff is 800 rupee, no GST when you artificially or when you split both the transaction, treating them to be not to be a composite supply. And the brand fee will continue to have its GST implication of 18%. However, it is advisable that the transaction should be considered as a composite supply and 12% should be paid on the entire value, which is 800 plus 250. No, so minimum guarantee containing with the minimum guarantee thing in the same transaction where assuming the hotel is not able to earn the guaranteed amount, then in this case, what happens is the hotel will recover the money which is the deficit from the e-commerce operator. So in the same transaction, e-commerce operator is earning commission for the room rent and they are receiving the minimum, they are acting as a recipient of the minimum guarantee services. Now, minimum guarantee services can be equated to liquidated damages. While we'll discuss about liquidated damages in the subsequent part of this presentation, but there are a lot of litigation going on, and the tax authorities are of the view that GST needs to be paid, assuming that this is a act of tolerating a situation or something. What needs to be we very mindful is netting off of commission and minimum guarantee should not be done. They should be reported as a separate transaction, and the GST should be paid on both of them at the gross level. Now, so OIDR, online information and database access and retrieval services, is also a part of e-commerce operator. So it's basically, when we see the definition, OIDR is a service whose delivery is mediated by information technology over the internet or through an electronic network. And I mean, the nature of supply has to be such that it is completely automated and there is minimal human intervention. So a simple example could be, while the definition talks about different services which are deemed or included in OIDR, which is advertising, cloud services, ebooks, digital content, digital storage, online gaming, all of these are considered as OIDR services. A simple example could be a subscription that anyone would have taken, say, of Tax India Online or any other repository for the tax needs that you have for your business. So that's a classic example of an OIDR service. Now, in case, as a general rule, when an e-commerce operator, e-commerce portal is outside India, then any person who is buying such goods is liable to pay GST as an importer in India when it's a B2B transaction. And in case of services by an e-commerce operator, which is located outside India, the liability to pay tax is on the recipient under reverse charge mechanism. These are, I'm talking about the B2B transactions. In B2C, import duty and reverse charge, both of them will not apply. So it's in a normal currency. However, when we talk about OIDR services, so OIDR is a service, which is provided mainly or without minimal intervention through the digital network. In case of OIDR, there is an exception to the general rule that when a person is supplying OIDR services to a B2C customer, then they are liable to take a registration in India and discharge the GST liability. Whereas for B2B transaction, the tax continues to be paid by the recipient under reverse charge mechanism. So this was basically provided, this was introduced to bring the Indian service providers and the foreign service providers at par. Because if an Indian supplier of service, OIDR service, is supplying a service through an e-commerce operator, then they were collecting GST and making payment. In case of a B2C transaction, GST becomes a cost. So people are very mindful of whether GST is to be paid or not. Whereas in case of a foreign supplier, because they were not liable to register in India, the services sought to be cheaper. So to curb down this anomaly, OIDR services were brought to tax, and this came right in the service tax era in 2016. Now, from a compliance perspective, the OIDR service provider can obtain a single registration for discharging GST liability for all the transactions that they do in India with a B2C, for a B2C transaction supply. And they also have the option to appoint a representative for obtaining registration and making the payment of taxes. Now we move on to some of the GST issues that we've seen in e-commerce business. So liquidated damages. So what happens is we see that in a lot of cases where the customer is, say, returning goods, or maybe not even returning goods, but the goods are directly being shipped by the supplier or the e-commerce operator, they are received by the customer in a damaged condition. Now, in case of damage, the e-commerce operators, they have a tie-up, or you can say agreement with the logistics service provider, where they charge a fixed amount as a penalty for each shipment where the goods are damaged or the goods are lost. Now, if you see from a industry perspective, it's a divided house. Some are paying GST on liquidated damages, and some of them are not paying GST on liquidated damages because there's a view which says that GST liquidated damages is not even a supply. From a tax authority's perspective, they always come up with this argument that there is a specific entry in Schedule 2. Schedule 2 is services deemed to be services, where it says agreeing to the obligation to refrain from an act or to tolerate an act or a situation or to do an act is a supply of service. So therefore, there is a toleration happening and it becomes an service automatically. Now, if you see any amount which is received under a contract as a compensation or liquidated damages cannot be termed as a consideration for provision of service. Now, penal clauses in the agreement, they are in the nature of providing a safeguard to the commercial interest of the parties. And this cannot by any stretch of imagination be said that recovering any sum by invoking a penal clause is the reason behind execution of the contract. So when you enter into a contract, the intent is not to earn money out of the event where you can recover penalty. The intent is, in case of an unforeseen situation, you safeguard your commercial risk. That's the limited intent of having these clauses in the agreement. So accordingly, compensation received cannot be considered as synonymous with tolerating an act or a situation. So the main intent here is for a supply, there has to be an active intent to do a service supply. None of the e-com operators intend to make money out of the penal implications. Now, when we go to the jurisprudence under the GST, there are adverse rulings passed by the GST authorities wherein liquidated damages has been treated as consideration for tolerating or non-performance. And it is held that such liquidated damages are liable to GST. While in some of the advanced rulings, it has been held that they are outside the purview. This is a very hot debated topic, but there are also positive rulings at high court level in service tax which says that GST should not be paid on liquidated damages. Now, it is pertinent to note that the adverse ruling have completely ignored the very important aspect that contract cannot be entered with the intention of the parties with non-performance of the contract. And thus compensation should not be equated with consideration. So it's active versus passive. Now, next, this seller protection fund is also similar to the liquidated damages. However, here the person who's receiving the damage is the seller. The seller is the supplier on the e-com platform. So various e-commerce operators to enroll more suppliers on their platform, they come out with different schemes and policies. So in case of seller protection fund, the suppliers are eligible to receive an amount up to 80% of the value of the returned product, which is damaged. Now, as an industry practice, most of the suppliers, they are not aware of the tax positions because these are small suppliers. They are just raising a financial debit note on the e-commerce operators and recovering this money. Now, from the perspective of payment of GST, now because the goods have been destroyed or lost, the sellers are reversing the input tax credit. So and in cases where the sellers are making the payment of GST on such liquidated damages or the seller protection fund, the same becomes a cost because then from a seller's perspective, say for example, the goods was worth 1,000 rupee, 200 rupee they recovered from the customer, or they've not recovered anything from the customer. However, 800 rupees was paid by the portal. So therefore they consider 800 to be an amount towards sale of goods or sale of services. And accordingly, they make the payment of GST. However, even when the suppliers are charging GST, the e-tailers or e-commerce operators cannot take credit because the underlying supply is, or you can say the supply is actually done by the procurement is done by the customer. Or in other words, the goods or the services are not purchased by the e-commerce companies and therefore they cannot avail credit. Now the tax position in this case will work exactly in the same way like how liquidated damages work. And this is a contentious issue. Now next, this is a interesting and practical problem that a lot of suppliers face. Now in various sectors, like especially garments, textile, the sales return can go as high as 30%, 40% of the total sales. And it is actually a logistical nightmare to ensure that the goods under the sales return are sent back to the originating state. So say, for example, a company is located in the state of Maharashtra. There is a customer in Delhi. The goods are shipped to the customer in Delhi. The customer, for whatever reason, rejects the goods or does not want to purchase the goods are returned. Now, company, for them, it is very difficult if the goods have to move back to Maharashtra because the logistical cost will again trigger in. Or the other option is they have another warehouse which is in the state of Haryana, Delhi share border, and it's a less costly affair if the goods move to Haryana. Now, when you see section 34, which talks about issuance of a credit note. So the section allows supplier to issue a credit note in case where goods supplied are returned by the recipient. However, the section does not require that the goods should actually be returned back to the same warehouse from where it was originally sold. So this is mere reading of section 34. It allows you to issue a credit note if the goods are returned. However, there is no condition explicitly mentioned that the goods have to move to the same originating state. Having said that, there is an ambiguity on the procedure to be followed in these cases and how the goods can be sent to the nearest warehouse to solve a practical problem and reduce the logistics cost. So here a lot of companies, they are structuring this transaction and following the following process. The first is the original GST registration, which is Maharashtra, from where the goods were supplied, issues a credit note adjusting the GST charged on the original supply. Then Maharashtra issues a stock transfer invoice along with applicable GST to their Haryana branch for receiving the return goods. And then the goods move directly from the customer to the nearest warehouse, which is Haryana. And the goods are then accounted as a purchase done by the state of Haryana. So this provision, a representation is also filed. However, there is no clarification by the government yet, but this is how practically a lot of suppliers are trying to undertake this transaction. Now, this is also another practical problem where e-commerce supplier, having multiple registration in different states, what they generally do is the season also keeps on changing in terms of the taste of the customer. So the goods keep on moving from one state to another. So in this example, say the company is in Maharashtra, they purchase goods from a manufacturer who is located in Goa. Now, whatever is to be purchased, and all the goods are coming to Maharashtra after whatever goods are required to be kept in Maharashtra, the other goods are then stock transferred to Haryana. Say, assuming there is a sale that has to be done, a festival is coming in Haryana where people are going to buy a particular type of cloth, and obviously to boost more sales, the supplier will offer them a quick delivery, and quick delivery is possible only when the goods are in the state which is nearest to the buyer. And after this, there is a possibility that the goods then again move to Karnataka from Haryana. Now, after all of this, there may be an arrangement with the brand manufacturer, the brand owner or the manufacturer, that whatever goods are left out, they will have to be returned or taken back by the manufacturer. So in such a scenario where the goods are to be returned to the manufacturer, it is practically impossible to move the goods back in the entire chain. Going from Karnataka to Haryana, Haryana to Maharashtra, and Maharashtra to Goa, this is illogical and not possible. Logistically, it will turn out to be a very expensive proposition. So hence the goods have to move directly from the last warehouse, which is the Karnataka warehouse, and then it has to go to the Goa directly. Now, in this case also, there is an ambiguity in relation to the documentation that are required for movement of such goods and what tax positions are to be adopted. Now, if you see, goods can be returned only to the person from whom you have purchased. So in this case, Karnataka has purchased goods from Haryana. However, the goods are being returned to Goa. So therefore, it cannot be a sales return transaction from Karnataka to Goa. So in this case, interestingly, two different approaches are being followed. The first is the documentation is that of a sales return, where each state through which the goods are moved are required to issue a credit note, while logistically the goods move back from the last warehouse to brand manufacturer. So it is very simple. Maharashtra issues a credit note to Haryana, Haryana issues to Karnataka. Similarly, manufacturer issues to Maharashtra. The entire transaction is reversed, and then the goods move from Karnataka to Goa. Now, having said this, this seems to be easier or flowing in the chain properly, but practically this creates a lot of problem because you have to deal with multiple states, including then with the manufacturer, and documentation, e-way bill, all of this becomes a very big hassle. So the other way out that the people have taken is such return of goods from the last warehouse is treated as a separate supply for GST purposes. So then they are treating this transaction to be a supply of goods from Karnataka to the manufacturer. Now, even though while they are doing this, the fact for accounting purposes, the transaction is still recorded as a purchase return and sales return. So when Karnataka is issuing an invoice on Goa, Karnataka will show this as a sale transaction. Goa will show this as a purchase transaction. I'm talking about the GST part. However, when you go to the books of accounts, now ABC Limited being one single company, for them, it will not be reported as a sale. It will still be a purchase return. And similarly for the manufacturer will also consider this as a purchase return, sales return in their accounting. But for GST purpose, it turns out to be a purchase. So this point is also there where clarity is awaited. Now, GST rate on combo packs. So we would have seen a lot of times, say a t-shirt. A t-shirt, you can buy one single t-shirt of a company for 500 rupees. Whereas if you buy 3 t-shirts as a combo pack, then they offer you a special discount of say 100 rupee. So therefore the price of the combo comes to 1200 rupees, 1200. But if you see the invoice or when you see the description on the e-commerce portal, it is clearly reflected that the unit price will be 400. Now this, I have recently seen this in case of Amazon. So if you go on Amazon to buy a product, and if you're registered as a business, they will give you 2 options. So they'll give you one option, but then there is a quantity table. So the moment you select 2 quantities, the per unit rate comes down. And similarly, when the quantity keeps on increasing, the rate comes down. And the mentioning of the amount is still per unit. Whereas at the time of checkout, you can see the price of the entire combo is 1200. Now, in case of apparels, there are 2 entries, and apparels are being taxed in GST basis on the sale value. So if you go to schedule 1, which is the 5% GST rate, it says article of apparel and clothing accessories or cap, topi, knitted, crocheted of sale value not exceeding 1000 per piece. So if the value of the item is less than 1000 per piece, the rate should be 5%. Similarly, if the rate per piece is more than 1000, then the GST rate should be 12%. Now, in case of a combo, the query is what GST rate should apply, whether 5%, 12%. So whether the rate of 5 or 12 should be levied should be determined basis the per piece value of goods and not on the combo price. So since in this case, the price of the individual product per piece is less than 1000, the GST rate should be 5%. However, in many e-commerce companies, we've seen this is a problem. There's a lacuna in the IT system where they have not been able to resolve it and they are still recovering 12% from the customer because the price of the combo goes up to 1200. So if there are suppliers on the portal, they need to be mindful of this fact. If the correct GST is being charged, plus at the same time, if the right GST, which is the lower GST is being charged, the customers will also have a benefit in terms of pricing, because any GST which is collected in excess needs to be paid back to the government. So this is a good opportunity for all the suppliers to see if the correct rate is there. But most of the companies are actually charging 12% because there's a system issue. Now, joint marketing scheme. So this is a very common marketing phenomena where you can see in e-commerce portal. So the supplier or the e-commerce portal, they tie up with banks or credit card companies where a customer is offered discount. So here, if you see the supplier, say for example, is offering a product for 50,000, which is the standard selling price on the portal. However, if the goods are purchased through a partner bank, so the supplier could partner with any banks, say for example, ICICI, HDFC, whatever. So if you are buying a particular mobile phone, say OnePlus phone, and you are purchasing through Axis Bank card, then you will get a flat 10% off, no questions being asked. So the customer can buy a goods worth 50,000, but they only pay 45,000 rupees because that's how the agreement has been run. However, behind the scene, this discount is actually shared between the bank and the supplier, or in cases where the e-commerce operator is offering this, then some portion of the discount is borne by the e-commerce operator, the balance is borne by the bank, and this could be in any proportion depending on the product, the bargaining capacity. In this example, we're talking about a case where the discount is shared between the partner bank and the supplier in the ratio of 50%. So therefore, what happens? The customer buying 50,000 worth of product immediately pays 45,000 to the e-commerce operator. The bank makes the payment of 2,500 to the e-commerce operator, which is their share. And the balance discount of 2,500 has to be borne by the supplier. Now here the question is, how do you charge GST? On which value GST is to be paid? So GST is to be discharged on the value of supply, which has to be determined as per section 15 of the Act. Now, when you go to section 15 very clearly says that GST has to be paid on the transaction value. And transaction value is the price that is actually paid or payable for the supply between unrelated recipients. So whatever is the commercial negotiation, whatever is the amount, that becomes the transaction value, the customer supplier being unrelated, and the amount which is actually paid by the customer. Initially, the upfront amount is 45,000. So that becomes the transaction value. Now, moving on further to section 15. In subsection 2, it talks about different line items that have to be included in the value of supply, any amount which is separately recovered. So one of the line items says the value of supply shall include subsidies that are directly linked to the price. So subsidy which is directly linked to the price, excluding the subsidies provided by the government. So here the bank is providing subsidy. It is not a government, so we leave government aside for the time being. But what is subsidy directly linked to the price? So the term subsidy is not defined in the GST law. Therefore, we see how it is understood in the general trade parlance. So subsidy generally means a financial aid or grant given by the government. However, here because the grant or subsidy by government is excluded, we leave the grant, the subsidy provided by government. So generally subsidy is provided by government. That's why this confusion comes. But subsidy means any payment which is a financial aid or a grant that is paid to the supplier with a specific instruction that the price of the goods have to be reduced. So in this case, the amount that is paid by the bank, that becomes a subsidy, and this subsidy is directly linked to the price because the supplier is obligated to reduce that money. So therefore, in this case, it can be said that the amount received by the bank is qualifying as a subsidy and it gets added to the transaction value. So therefore, from a supplier's perspective, 45,000 plus 2,500 should be the value on which GST should be paid. The amount of 2,500, which is the discount offered by the supplier. So this also gets excluded from the section 15 itself, which says any discount which is provided upfront. So this discount which is borne by the supplier should not be added to the value. However, in practice, when you see any invoices issued by e-commerce operators, what they generally do is they are levying GST on the entire value of 50,000. So 50,000 is the amount inclusive of GST. The GST is back computed, and then they allow a discount of 5,000. So if you see from a customer's perspective, GST is paid on 50,000 rupees. There is a reduction of 5,000 rupees, which is the discount as per the scheme. For them, they have to pay only 45,000. So their outgo remains the same. However, if it is a B2B customer, then they are eligible to avail ITC only to the extent of amount that they have borne. So GST that forms part of the value of 45,000. That is the amount of GST which has been borne by the customer, and the customer gets credit only of that amount. Hence, the GST paid on the discount portion of 2,500, which is the supplier part, that becomes an excess payment of GST, and it is a direct cost to the supplier. Now, moving ahead with the same thing where GST is paid on 47,500. 2,500 is paid by the bank, 45,000 is paid by the customer. Supplier pays GST on 47,500. Now, we saw that the customer will be eligible for GST only to the tune of 45,000. However, the GST component which is forming part of the 2,500 which is paid by the bank is not allowed to take credit of that portion, for the simple reason being that there is only one supply that is happening. There is a supply of mobile phone from supplier to the customer. The payment is made by two people, customer plus bank. However, the bank is not doing any procurements. So therefore, the bank is not eligible to avail input tax credit of the 2,500 amount. Now here there is a structuring opportunity where if the transaction between the bank and the supplier is that of a marketing service where the supplier becomes the service provider. In that case, the invoice continues to be 45,000 rupees, which is the value of value of the goods. However, 2,500 payable by the bank is a service fee for the marketing or the promotion that the supplier does, because wherever you see the advertisement, say for example Samsung or Apple, they will write HDFC is the banking partner. So that's the kind of marketing that happens. So therefore, if the transaction is structured like a service fee, then whatever GST supplier charges on the 2,500 is creditable to the bank. So the customer gets credit of 4,500, bank get 45,000, the bank gets credit of 2,500. So no GST is lost in the transaction. Now, apart from this, another issue that comes up in these kind of arrangements is a deemed service kind of a thing, where, as I said, the supplier, Samsung or Apple, they will clearly write that HDFC or a particular bank is their banking partner. They are the exclusive channel partner. Similarly, the bank on their website, they will also promote or advertise that, with with a HDFC card, you can go ahead and buy Apple phone for 10,000 rupees less. So what happens is the supplier and the bank, both of them are promoting the offer or the scheme. So it can be said that they are actually promoting each other's business. And therefore the tax authorities can form a view that they are supplying marketing services to each other, and that is in the form of a barter, where none of the parties are raising any invoices on each other. So therefore this service needs to be valued and GST needs to be paid on this. So in this case, the argument would still be that the simpler way could be both the parties ascribe a value. It could be a nominal value, any value that they want, raise invoice on each other, take credit. But in case of bank, they are not allowed to take full credit. 50% of the credit is wasted. So therefore that may not work out. So the industry is taking a no supply position on this, wherein the key arguments are that there is no intent to promote each other. Whatever marketing, whatever communication is being done is done to promote my own business. So if I have to promote my own business and at the same time someone else's business is getting promoted, then that should not amount to a conscious supply being done by the supplier to the bank. And that same case applies for bank to the supplier. Now, from a documentation perspective, if your supplier is having an agreement with the bank, then these clauses should be specifically brought in the agreement that there is no intent to supply any services. Plus, there will be exchange of trademark copyrights, because bank will use Apple's logo, Apple will use bank logo. So therefore, there is IPR involved. We can strictly mention that IPR is limited purpose right is given to use IPR on a royalty free basis. So there is another way where we can curb the risk of this being considered as a marketing service. Now this is a standard issues with all large e-commerce operators, or as we see in case of a startup, where they are actually a loss-making entity and the cost being higher, there is a lot of ITC that gets accumulated. Now this could be for the reasons, as we saw that in some cases there are credit notes which are issued where GST is not adjusted. So a financial credit note, therefore a GST amount is not being reversed by the e-commerce operator, supply below cost, or they are loss making, the costs are very high. So the ITC keeps on accumulating. So here there is a good structuring opportunity if we are able to better manage the cash flows for the e-commerce operator. So there are many instances where the e-commerce operator will have a liability to be paid in cash, say in the state of Maharashtra. However, Delhi, because they've opened a new warehouse or they've done capital expenditure, Delhi will have a lot of ITC balance with them. So in this case, one of the ways could be that the e-commerce operator enters into a consolidated billing model and all the states. Say, for example, a company which is present in 20 states, the head office in Delhi becomes the consolidated billing location, whereas all the other states, they become a support service provider to the head office for executing the contracts. Now, in this case, there is one option that the money, that the credit can be transferred by way of cross charge. For cross charge, you need to adopt a fair market value, or sorry, or rather a open market value concept is there under the GST law. However, there is an exception to open market value, which says where the recipient of supply is eligible to avail full credit of the invoice, then whatever amount is charged becomes or is deemed to be the open market value for the transaction. So similarly, in case of e-commerce operator, which are engaged completely in providing a taxable supply, there is no exempt supply, therefore no reversal of ITC. Whatever amount will be cross-charged from one particular state will be eligible in totality, and therefore the benefit of this proviso can be availed. There are multiple advanced rulings which have consistently held that you can charge the amount whatever you want, and by virtue of this proviso, it will be deemed to be the open market value, and tax authorities will not have any say to challenge the transaction value. So here, like we've also implemented this model in a lot of companies where you enter into a inter-office agreement, and the cross charge, the value of cross charge will be dependent on a formula, and the formula would be the ITC that you availed in the last month, that divided by 18% is the value of service for the next month. So that's how the credit keeps on moving to the head office and everything gets accumulated, or rather the credit moves to one place and the same is used for payment of tax liability and cash payment is avoided. Now, having said that, recently in a couple of days ago, there was a High Court decision which said that if you are doing cross charge, the benefit of proviso or valuation is still available. However, there has to be a substance. So substance is that there has to be some activity which needs to be performed by the head, the branch offices. So therefore, whenever you're implementing this, you need to ensure that there are proper service or items which can be said that the branch is performing XYZ function and for which they are charging us the service fee. The service fee value cannot be challenged, but there has to be some service or some activity that needs to be done by the branch. Now, and when we talk about a lot of cases where credit note is issued without GST, this being primarily on account of, say, non-fulfillment of condition under section 15 for reducing or issuing a taxable credit note. So all of these cases should be explored, and wherever possible, a tax credit note should be issued. Similarly, when we talk about cases like liquidated damages, which is recovered from the logistics service provider, if the logistics service provider agrees and they are eligible to take full credit, it is always advisable that you keep charging GST. This will serve the dual benefit. One is you reduce the litigation, and at the same time, the credit keeps on liquidating. Lastly, in case of inverted duty structure, the possibility of refund can be explored. So inverted duty structure is, interestingly, when you go to the law, it talks about inverted duty structure in relation to goods, where the rate on inputs is higher than the rate on output. So for a services sector, it may not be possible to avail the inverted duty structure. While this provision was being challenged that, service providers and the supplier of goods are not being treated at par, the matter in case of VKC footwear went up to Supreme Court, but the Supreme Court has held that whatever is provided in the GST law is the right position and you need to follow. However, at the same time, they've left that the option is on the GST Council to analyze this issue. And if they want, they can recommend that the service provider will also be eligible for inverted duty structure refund. So if that sees the light of the day, then a lot of e-commerce operators are ready to catch that opportunity. Now we talk about the few the FAQ that was issued in relation to the TCS compliances. As you can see on the screen, there for a single transaction, there could be multiple e-commerce operators that are involved. So in multiple e-commerce operators, could be say, for example, a customer is going to a particular website for booking a hotel. The hotel is, the platform is in turn integrated with another e-commerce operator, and that e-commerce operator is having a contact with the hotelier. So here there is customer logging into e-commerce one going to e-commerce two, and e-commerce two is then having a contract with the hotelier. So in this case, what happens is the transaction, the e-commerce transaction is taking place at e-commerce one portal, which is the first portal. However, they have no privity of contract with the hotelier. So therefore, they are not able to collect TCS from the hotel directly. So in this case, the FAQ has come out with a clarification that TCS obligation will continue to be with e-commerce operator 2, who is actually making the payment to the hotel. So this resolves the problem of TCS. However, in case where the hotelier is not registered, then the liability of paying tax under section 9(5) as an aggregator will come down to e-commerce one. So e-commerce one will have to pay tax as an aggregator. So they will collect the money from e-commerce 2, and e-commerce 2 collects the money from hotelier. That's how the transaction will flow. So for this kind of a transaction, for TCS, e-commerce 2 will be the right person. For aggregator, e-commerce 1 becomes the right person. Second is TCS on collection of consideration or at the time of supply. Now, if you see, interestingly, the provision of TCS apply only in case where the operator is collecting consideration from the customer. So say, for example, in case of a cash on delivery services, invoice or goods are shipped on 30th of October, so this is the example we are continuing in the FAQ. Booked on 30th of October, the goods get delivered say on 3rd of or 2nd of November. And the money is also collected on 3rd of November. So in this case, what will happen? Should I go ahead and pay TCS in the month of October when the invoice was issued? Or should we go to November when the consideration was actually realized? Because TCS is applicable only when the money is received from the customer. So in this case, the FAQ has clarified that TCS should be reported with respect to return filed for the month of October only. So this in some cases may lead to blockage of funds, but that's how the clarification has come out. Now, what will happen for TCS compliance in case of returns and refunds? So a lot of companies come out with a 7-day return policy, 10-day return policy, and so on and so forth, where the customer is at their free will allowed to order the product, see the product. If they are not satisfied, then they can go ahead and return the product. So in such a case, what may happen is, how does the TCS compliance should be done? So the section 52 has an explanation which says TCS. So section 52 says TCS should be done on the net value of taxable supplies. And the explanation defines what is net taxable supplies. So net value of taxable supplies is the aggregate value of all the supplies that the supplier has done, minus the returns that have also been coming against the supplies made by that supplier. So whatever is the net amount, that net amount should be considered for TCS purposes. and this net amount has to be computed separately for each supplier. So it is not to be done at a consolidated level by the e-commerce operator. It is to be done separately for each supplier, and whatever is the net value, that needs to be considered for TCS. Now, in this case, the say for in a particular month, the returns are higher than the sales, then there would be a negative amount. So in this case, the circular clarifies that no TCS has to be done and the amount should be reported as nil, because there is no facility to report a negative value. Now the question remains, say after reducing the returns and there is a negative balance that comes, will that money be carried forward for adjustment in the subsequent month? That is still a query and no one really has an answer. But on a practical basis, the e-commerce operators are only restricting this computation on a month-on-month basis. So in one particular month, there is an excess return, no TCS is deducted, but the excess amount is not taken to the next month. Now, second, then we move on to another instance, say where the contracts for a hotel booking, the e-commerce operator allows you to make the payment at a hotel. So what happens? The customer books the hotel through a website, all the payments, GST, everything is being made, but the payment is not collected by the e-commerce operator on the portal. So the e-commerce operator then has a tie-up with the bank, with the hotel, where they collect the money and they deposit the money in the bank account which is belonging to the e-commerce operator. Now the question here really is TCS still payable in this case? Because the liability arises where the supplier is supplying goods through e-commerce operator and consideration is collected by the said e-commerce operator. So here the consideration is not directly collected by the e-commerce operator, but indirectly through the hotelier, who is collecting from the customer and making payment to the operator. So in this case also, there is an ambiguity whether GST needs TCS needs to be done, but on a safer side, TCS is being done. Now, supply of service to SEZ. So in a lot of cases, a SEZ unit, as we all know, that any unit which is located in the SEZ, they have certain privileges where any supplies made to them are not offered to GST. So earlier, sorry, before the Finance Act 2021, so Section 16 was very simple. Section 16 of the IGST Act read that any supplies to an economic zone or developer shall be treated as a zero rated supply. So by virtue of this section, anything you don't have to, or the customer was not required, vendor was not required to look at the activity of the SEZ unit. They were granting the exemption or as benefit of zero rating. However, when such suppliers, they went to the GST authorities for taking refund of such supplies, such zero rated supplies, the rules required them to get a endorsement of the proper officer that the supplies have been made for authorized operation. So this anomaly was rectified in 2021, where the section was amended to say that supplies to a special economic zone will be treated as a zero rated supply only if such supplies have been received for authorized operation. Now, so therefore, what became important is the supplies have to be used for authorized operation. So a lot of these SEZ entities are registered on the e-commerce portals, and the e-commerce portal has a specific checkbox. So whenever you create a profile, there is a specific checkbox where you can mention that you are a SEZ unit or not. And the moment you tick the box, they verify your GST registration with the GST database and then grant the benefit of zero rating. Now this provision was passed, the Finance Act was passed, but this provision is not yet notified. Now, there may be various reasons why it is not yet notified, because the government has not come out with any clarification of how do you determine whether the services or the supplies are used for authorized operations. Now the industry is preparing on their own to put in place a system or a check to ensure that the compliance is done irrespective of when the clarification comes out. So if you see in case of supply of goods, there is a profit officer standing at the entrance, and without endorsement, the goods cannot move into the SEZ. So therefore, any goods that are procured by a SEZ unit, they are stamped at the time of entry itself. So therefore, this problem may really not come up for the goods supplier. However, when you talk about services, now supply of services, there is no one who's going to actually see how the supply is done, or they have any, I mean, it's completely intangible. There is nothing that a proper officer can do. So therefore, the problem here is how do you determine whether the services are used for authorized operation? Because in case the supplier on the e-commerce portal gives the benefit of 0 rating, where such benefit was not available, then the government will definitely come back to the supplier and recover that money along with interest. So therefore, there are 3 or 4 different methodologies that are being put in place. One, and this is the most advisable thing, that the e-commerce operator should put a declaration, a mandatory declaration for the SEZ registered person, that they have to mention that whatever supplies they are making or taking from the portal will be used for authorized operations. And there has to be a suitable indemnity which mentions that in case the authorities will hold that such supplies are not used for authorized operation, then they will indemnify or make the payment of such GST along with interest. So this is to cover yourself from a commercial perspective. Second, every SEZ unit, they file a quarterly DTA service procurement form where they have to report all the services that they've procured during the period. And at the same time, for every invoice, they can approach the proper officer to get an endorsement. However, this is practically very difficult basis whatever practices are being adopted by the proper officer and the compliance burden. So therefore, the next option which comes is, so there is a uniform list of service. So the SEZ Development Commissioner, they've specified a list of around 67 services which are deemed to be used for authorized operation. So therefore, if any of such services are provided, then such services will be deemed to be used for authorized operation, and no further, you can say, investigation or scrutiny needs to be done. So this includes a lot of service: CHA, legal, chartered accountant, commercial training, coaching, IT services. So if your service falls under any of those notified list, then you are eligible for the exemption. The second option is, if a particular service is not forming part of the uniform list of services, then the SEZ unit will have to approach the unit approval committee. So unit approval committee is a committee which will see the application and determine whether such services are actually required for authorized operation. And if the answer to this is yes, they will go ahead and approve. So if your services are approved by the unit approval committee, you are still eligible for exemption. Now, there is one more option. However, it may not be so foolproof, but when you go to the service tax regime, there was a concept of form A1, A2. So A1 is where the SEZ unit had to apply to the authorities saying that these are the services that I'm procuring. And the authorities replied in form A2 saying that, yeah, okay, you can procure these services without payment of tax because these are used for your authorized operation. So if it is an existing client which was there under the service tax regime who had an A2 for your services, then a chance may still be taken, because if a service was approved in the service tax regime to be used for authorized operation, then without any change in the business model or facts, the services should still logically be considered as used for authorized operation and GST. So anyone who's supplying to a SEZ unit should be mindful of these aspects. Now, the last issue that we talk about is the registration. We've already seen that any person who's supplying goods on the e-commerce portal is mandatorily required to obtain a GST registration without any threshold exemption. So this is creating a lot of problem, and primarily for a small startup, small e-commerce startups, because they are dealing with small traders or small or tier 2, tier 3 cities. So, and people over there are not willing to take registration. So this matter is being vehemently represented before the GST Council, and 3-4 days before, there was a article in Mint, which is a screenshot of this is there, which says registration norms are likely to be eased for online suppliers. So government is working on it. However, and till the time this comes out, for small e-commerce operators, one of the way they are adopting is they are putting up their own entity, which is registered on the portal, obtains a GST registration, acts as a supplier on the portal. They enter into a back-to-back arrangements with these unregistered players. So whenever an order is received on the on the e-commerce portal, this company, the group company of the portal, buys or purchases these goods from the unregistered suppliers and supplies it to the customer. So this is a stopgap arrangement, and we expect that the issue will be resolved faster and sooner. Now we move on to the last section of our presentation, which is the representation points that have been given by various forums to the government, and the other regulation that should be generally taken care of. So the first issue we've already discussed is about GST registration. So the government is possibly working on this, and hopefully we will get this exemption for service supplier of goods. The second restriction for any supplier on the e-commerce portal is that they have to compulsorily be under the regular scheme, because if they opt for composition scheme, they are not allowed to sell on e-commerce portal. So this is the second point of representation where the government is working, and they may possibly, it is expected they may come out with a mechanism where they will allow composition dealers with TCS, composition dealers to sell on the platform, and the TCS implications should apply. Now the third is a practical problem, which is allowing sellers to register e-coms operator as additional place. So now if you see, as we saw in case of large companies who have multiple warehouses, they can keep on moving their goods to different warehouses, but a small seller registered in one single state needs to supply goods to different states, and also wants to be nearer to the customer so as to ensure quick and timely delivery. They need to apply as a regular GST registration in those states on the same premises, on the premises of the warehouser. So they keep to the e-commerce operator, the warehouse operator, they obtain the document and obtain a regular registration for them. So, but this becomes a problem because practically off late, we've been seeing that in last 2 or 3 months, the GST authorities are only seeing or finding reasons to disallow or reject the GST registration application. So they come to these places, they say there is no person who's sitting, there is no physical setup, there are no infrastructure of the seller, the supplier, or the e-commerce portal, and therefore these places are being, the registration applications are being rejected. So here the ask really is, like as we saw in case of a TCS registration, where the e-commerce operator is allowed to obtain registration in any state by declaring the head office in the main state as the registered premises and take a registration. A similar relaxation is being sought for the suppliers, where they can declare operators warehouse as their place of business for registration as an additional place with minimal documentation. Now, when we saw section 9.5 services, one of the cases was housekeeping, carpentry, and similar services. So there, normally for other services, some of the suppliers are allowed to take benefit of threshold. However, in this case, the e-commerce operator is liable to pay GST as an aggregator. So this creates a distortion between an offline service provider and an online service provider. So this is also being asked. Then the last on the representation bit is the registration requirement. So if you recall the discussion we had in case of sales return, say a customer, the supplier is in the state of Maharashtra, the goods are sent to Delhi, the customer rejects, the goods have to come back to Maharashtra. They don't have another warehouse in a nearby location, or the supplier is a position to getting the goods back to the originating state. So in this case, what happens is, to avoid or to save on the logistics cost, the delivery partner will temporarily store the goods in their premises for some time, aggregate the different materials that have to go to the source location, Maharashtra in this example, and then the goods are moved to the original location. So this may lead to delay in or storing of goods in the delivery operator's premises for 5 days, 7 days, or whatever number of days. Now, if you see the GST law, a registration needs to be obtained for each place of business, and place of business has been defined in a manner to mean that a place where goods are stored also becomes your place of business. So therefore, this representation is being made specifically for e-commerce suppliers in case of returns, where the goods are stored in someone else's premises for a temporary period. They should not be obligated or mandated to take a registration in such location. Now, this is moving on to the last slide. So here, what we've tried to capture is all the miscellaneous regulations that are applicable in case of an e-commerce operator. So you have any clients who's starting an e-commerce operation business, you need to be mindful, and apart from GST, we can put value and provide them with additional information. So a shop and establishment, it's a standard license that is to be taken for in each state. Now, interesting, coming to the personal data protection bill. So this is a bill which tries to safeguard the personal data protection of the consumers or the person who are registered on the portal, which requires, so potentially the bill is proposing the following compliances, which is like limited storage of data and deletion of the data after the satisfaction of the purpose for which it was obtained. Secondly, seeking prior consent from the customers before processing any personal data received from them, including their prescribed choices. And manner of processing of data, period of retention, everything is provided in the bill. So this is to safeguard that your data is not being misused by any of the portals or the e-commerce operators. Consumer protection. So this is more from a consumer perspective, where the operator is required to appoint a nodal officer to ensure compliance with regulations and a grievance officer to redress the customer grievance. Adequate disclosures to be made on the platform regarding the contact details of the operator. So if any customer has any problem, they can directly reach out to the nodal officer. Information technology guide. This is more from the perspective of the operator is not allowed to display any products which are defamatory, obscene, pornographic content, grossly harmful, harassing, or which is encouraging money laundering or gambling or any of these things. So therefore, you have to be very mindful of what data is being published on the e-commerce portal. Legal Metrology Act basically deals with the pre-packaged goods that are provided or offered on the portal. It could be like any packed food, like a biscuit, for example. So it is the duty of the operator. It is the duty of the operator to display the requisite information about the display of the goods on the website, such as the dimensions, weight, feature. So when we see the portal, we see a lot of description about goods and in terms of weight, dimension for the products, and we keep wondering why this excess information is there. So there is a regulation and there is a reason which makes it mandatory for the operators to publish this data. Now, Sale of Goods Act, it's an age-old act which still is being used for a lot of legal and commercial transaction disputes. So Sale of Good Act casts the duty of the operator to display in respect of the product, the warranties, the condition, and the factual existence or non-existence of the refund return policy of the goods displayed on the website. So therefore, the operator needs to ensure that all the details about the warranties, condition, refund policies are properly mentioned on the website. Then lastly, the IP, this is more from the perspective of ensuring that there is no infringement of copyright or trademark of any of the party. So the operator is bound to keep secured all the trademarks and copyright of the goods that are displayed on the website by the seller. So to prevent misuse of the copyrighted or other articles on the portal. So these are all other regulation miscellaneous things which the operator needs to be taking care of. I think that brings me to the end of the presentation. And thank you everyone for listening and providing this opportunity to present this e-commerce sector to all of you.
Thank you, Asif sir. I think can you see the questions which members have
I think
posted in the Q&A or chat box?
There are, I think it is about presentation.
Presentations, okay.
Presentation. What we can do is, I mean, if these are there, we can take it up and then I can, offline reply to the members, or I can pass on the information through you.
Okay, that's perfectly fine. And if I received anything on WRC website, of course, I'll share with you.
Sure, no problem. That would work. So if there's anything, we can connect and respond to the members.
Perfectly fine. So, well, thank you so much on behalf of WRC. I would like to present a hearty vote of thanks to you for your wonderful deliberation and sharing your valuable time with all of us. And I'm sure my participants will be benefited from your speak. So thank you, sir.
Yep, I think, yeah. Sure, then I think we are on time. It's 6:58. We are.
Yeah. So of course, if nothing is there, so we can, I think, close it and we can conclude for
definitely.
today.
But if there are any questions, then you can definitely, share it with me. I'll respond to all of them.
Yeah, sure. Definitely,
All right.
I'll forward it to you.
Yeah.
If anything
Thank you.
comes.
All right. Thank you. Thank you, everyone, for joining in.
Thank you.
And
Thank you so much.
Gautam and the WIRC team for this opportunity.
Yeah. Thank you so much.